Hi. In the banking space, provisional numbers for Q1 of this financial year seem to suggest that credit growth is impacted. This may be due to three reasons: state-wise lockdowns in the months of April and May, continued risk aversions by banks, and banks opting to park funds with the Reserve Bank of India. Late last month, the Financial Conditions Index, which tracks variables like money, bonds, forex, and the stock markets, dived from 72.5 to 59.1, with all sub-indices moderating. However, the CII and the Indian Banks Association, pursuant to a survey, established that an index above 50 is not a cause of worry and indicates some level of optimism. Credit growth in the system in Q1 was up 5.9% year-on-year, but has contracted 1.2% year-to-date. The IBA and the CII have indicated that lockdowns have also led to lower short-term fund requirements by corporates. The second wave seems to have muted credit growth. However, the sector was better prepared and the impact should be lower than that of the first. Growth momentum for deposits, however, is expected to continue, aided by retail deposits. Deposits are projected to have grown 10.3% year-on-year and 1.2% year-to-date. While leading private lender, HDFC Bank's filings project a 1.3% growth quarter-on-quarter, driven by wholesale credit. Retail disbursements have been projected to come down by 30% quarter-on-quarter, with a CASA ratio coming down 60 basis points quarter-on-quarter. The loans to deposits ratio of banks is expected to be muted, which may keep net interest margins under pressure and impact earnings. Earnings could see further pressure due to higher NPAs and slippages, with collection efficiencies witnessing a meaningful dip in the month of April. The RBI has projected NPAs of scheduled commercial banks to be as high as 11.2% by the end of this fiscal. Lenders to microfinance institutions and tourism-related companies are also expected to witness some delinquencies. The RBI, though, has pointed out that banks have sufficient capital and healthy provision ratios to deal with the projected stress in the system. Further, looking ahead, pent-up demand, rising input costs, capacity utilizations should keep retail growth unabated and boost capex-led credit growth. Overall, the environment remains conducive for large banks having a wide customer base and branch network, with a focus on digital and retail. Capital adequacy will also be a relevant metric to look out for. Thank you.